because today you may get some asset at a particular price, but tomorrow it may be more expensive. So if you are investing, it means that you should be able to get a better return or more money than what you are trying to than the benefit you are getting today. Otherwise, there is no point in investing the investments. The second characteristic is funds must lead to acquisition of assets. So there should be funds, number one. Number two, the fund should be the investment should be able to return the funds. That is one thing. And then whatever is invested in the investments, that investment should be used for and or it should lead to acquisition of asset. If you give it to somebody, or if you just use it for your purpose, maybe at a later date, if you put it in a almirah and use it for a later purpose, that is not acquisition of funds, acquisition of assets. The investment means there should be definite acquisition of a financial asset. It may be financial, it may be physical, or it may be real asset, whatever it is. But there should be definitely an acquisition of asset. Otherwise, it cannot be called as an investment. Next is assets acquired must give some benefit in future. So, whatever you are acquiring in the form of assets, they should give some benefit. Otherwise, what will happen is, you have acquired the asset, but if it is not giving any return, so that means your investment is not fruitful. You may not, if that is not happening, then why should somebody invest in a particular asset? If you are getting a return which is much more than your time value of the money. Time value of the money means the inflationary effect on your investment, whatever is the impact for that particular rate, and if you are going to get more than that particular level of return, then only it is a worthwhile investment. Otherwise, there is no point in investing in those assets. When we come to this particular course in the per se, the context in which we are going to discuss in this particular in this particular course and particular unit, when you say it is security analysis and portfolio management, mostly we talk about the financial assets. We don't talk about real assets or even what do we say, physical assets. So, in this course, the entire focus of this course is related to the financial assets. They are say like equity shares, bonds, different forms that we will discuss later. So the whole focus of this course is on the financial assets. That one should keep in mind. Coming to the next thing, next slide. First, let us see what is investment. What is investment? Investment takes place when an investor postpones his or her consumption, which is initially converted into savings and subsequently into investments. There are three important keywords in this particular we may not call it as a definition, but as a meaning in this particular statement explaining what is the investment. That is postponing his or her consumption. So if you are consuming today everything, you are not saving anything, thereby there is no investment. That means whatever income you are going to get today, you are postponing it to a later date, because you may think that there may be a need after maybe few days or few years or few months. So you are postponing your consumption today. Whatever needs you are having, you are postponing them to a later date, and thereby you are putting it as a savings. So once you put it as a savings, if you don't invest it in a revenue giving or return giving asset, it is worthless, because without giving a return, what is the meaning of a saving? When you are postponing your needs and when you are postponing your consumption patterns to a later date, that should cover at least two things. One is the time value of the inflationary effect of your money, and plus something more. If these two are not covered, there is no logic for postponing your consumption. Because if you are going to get the same amount of money, same amount of same value, real value of the money, even at a later date, then there is no point of investing. That you can very well buy the same assets or whatever your needs and consume the money today itself, instead of waiting for another 5 years or 4 years. So if that investment is not covering the inflationary effect of the on the investment, and plus it should cover some more, then only it is worthwhile investment. So when we say what is investment, the investment is the postponement of the consumption, which will lead to saving, and it may be subsequently invested, and maybe in a financial asset, maybe in a real asset, maybe in a physical asset, like that. So unless these three things are there, it is not really an investment. Savings, the relationship between the savings and investments. Savings, if not invested, lose. As I have told you, savings, if you are not going to invest, just keeping your money, you have saved some money, but you have kept it in the iron safe, your personal iron safe, then you cannot say it is an investment, because, and you cannot say it is investment first of all, and then the value also, the value of the asset also, or the value of the savings also get eroded, or the value of that particular savings the value loses. Value invested, if it is not invested, the savings is going to lose the value. I will just explain. If you are just putting the, say if you have saved a lakh of rupees and you are putting it in a safe and just watching it for 2-3 years, and after 2 years, if you want to buy, suppose say a car, today you would have got it for your 2 lakhs today, but after 2 years maybe the cost of the car may go to 3 lakhs, but your investment which is there in the iron safe remain as 2 lakhs only. So that means you have today whatever asset you are going to get for the same money, tomorrow, tomorrow means maybe after a few months or few years, you may not be able to get the same asset for the same value of money, same amount of money. That means the worth of your purchasing worth of your savings has lost. It has gone down. So unless the saving is invested, that means unless you invest these 2 lakhs in a particular asset and get a revenue which is more than your inflationary rate, and maybe plus that, unless you do that, your value of the savings value is going to be less. So unless you do a investment, saving has no meaning. Just putting it in iron safe is not going to help you. Then when you have this savings, the options are many, because It depends, again, it depends how many options or what kind of options you have. I think most of us are aware. Two things are going to decide in this particular thing. How long you are going to keep your funds for in the investment. If you are going to invest in a, see, just a simple example, for example, when you go to a bank, you get, you can just see the rates of interest for the fixed deposits. If you are just investing it for 6 months, the particular rate, maybe say 6% or 5% may be the rate. But if you are going for 5 years, you may go up to say 9% or even more. So which means if you are ready to if you are ready to invest your money or your savings and postpone your consumption for a future date, and the longer the time span you are going to postpone or invest in the assets, the return also will be more. You can very easily see it from your, just you go to a bank, just watch. I think most of you are already working people, so you know this particular thing very well. When you are postponing your consumption, future needs, by the time more you postpone, the time span is more, then you are going to get a better rate. Similarly, the another important thing is how much risk you are ready to take. The risk means if you are ready to take more risk, the return on your investment also is going to be more. To just give an example, if you are not ready to take the risk, what we normally do, we go to a bank and we will put it in a savings deposit or even maybe a fixed deposit. So you may get something like say 9% or so if you are going to invest it for 5 years, like that. And if you are slightly inclined to take risk, and if you go to a particular company and put it in the bonds of the company or deposits of the companies, if you are ready to buy the bonds, you may be, or even units, for example. If you are ready to buy the units, that means you are ready to, the units, when you are buying units, that the net value of those units may be, sometimes it is more less than the expected return. So there is a certain element of risk in that. So if you are ready to take the risk of getting a lesser return, then there is a strong possibility of getting more return. So two things are very important in this particular thing. One is, the more you postpone the more time frame you are going to give it for your investment, the return usually is more. Similarly, the more you are ready to take the risk, there is a chance of getting more return also. So these two things are very, very critical in the whole of investment process. I think in the next sections of this unit, we are going to elaborate these two things. The more time you are going to put the money in the investment, you are going to get more return, and the more risk you are ready to take, you are going to get the more return. So these two things are very important. Yeah, coming to the next slide. As we were just discussing, the investment process is a trade-off between the present consumption and future consumption. When we say present consumption, if you are going to consume the entire amount today, there is no saving and there is no return also. And if you are going to put all your revenue in as an investment, you are ready to wait for some time, then your future consumption, that means you are postponing the whole whole of your present consumption to a future date. So you are going to get a better return. I will just explain you this thing, the graph. See, on the C1 we have shown you the return, what kind of return you are going to get, and on the OC axis, OC0 axis, we are showing the investment. So if you are if your investment today if you are investing say if you have 50,000 rupees, let us assume that you have 50,000 rupees, and you have an option of investing the money, investing this 50,000 rupees at the rate of 10%, and for a year you are ready to invest. So that means your 50,000 you are investing today, and after 1 year you are going to get 55,000. Okay, that is at the rate of 10%, you are going to get 55,000 rupees. No consumption here. The whole of your money you are putting it as a investment. That means your future consumption you are investing the money for your future consumption, and that future consumption is 1 year, and after 1 year you are going to get 55,000 rupees. The other extreme is you are going to consume the whole of 50,000, whatever is there, you are going to consume it today. That means you are going to get a zero return. That means after 1 year you will not have anything to consume. So this is one extreme, and this is another extreme. So the investment is a trade-off. It depends on your needs, how much you need today and how much you need for the future, how much you can postpone, how much of your needs you can postpone it to future, so that you can save the money for your future consumption. For example, this is this is one extreme, and the other one is the other extreme. So there may be a situation, third situation, where you have consumed your 30,000 rupees and invested 20,000 rupees in for the future. So what will happen in such case? The 20,000 is going to earn you another 2,000 rupees. That is increase of 10% after that year. So the total investment process is the trade-off between present consumption and future consumption. So this is going to tell us how you are first time frame, how much time frame you are going to defer your consumption needs. So if you are putting more income, more this thing, future, you will get a better returns. And if you are not able to postpone your consumption, there is no investment, there is no saving, no investment, no future returns. That is the principle. Maybe okay. We are talking about investor, and so far I think in the last say 15 minutes we have been talking about investors. So what is an investor, who is an investor, and who is a speculator? This is a very important thing to understand, because if you don't understand who is an investor and who is a speculator, that is going to create a problem, and that is not going to give a proper yeah. Two things are very there is a in the market we have two types of people actually. Both are okay. In the very crude sense, you can say both are investors, but you have to distinguish them because their goals are different in nature. We will try to distinguish. The speculator is a person who speculates, who just speculates for the money. He is not an investor. He is not ready to give them put the money, invest there for some time, stay there, get good some return and go back. That is the investment pattern. But a speculator is not like that. He doesn't have any sentiments, any particular time frames, any particular this thing. Wherever there is an opportunity, he will enter and then he will just very quickly he will get in and if required, with the same speed he go back. He will just disinvest and come out of the market. That is the basic difference. Coming to the time frame, when we are talking about speculator, he is very short time, means he will put the money for a short time. He cannot wait for long time because there may be several compulsions, or he may be looking for several opportunities. So whenever there is a opportunity, he will quickly jump into that, make money from that situation, and just with the same speed he comes out of the situation. But an investor is not like that. He is putting the money means he will wait for some time. He will wait for the return to come, and whenever he is required, that is future consumption. Whenever there is a future consumption, he may get out of the market. So the time framework of the speculator is short and the investor is long. Similarly, if you come to the returns angle, the speculator is going to get abnormal and quick returns because he is just getting into the right time, getting at the right time and into the right situation. So there is a chance of getting more return and quick return. But whereas an investor, he is slightly stable and consistent, so he gets a good return but not very abnormal type of return. Again, this return and risk are related. So coming to the last point, I am just for the moment I am omitting this particular movement part. Return and risk, just compare it. When your returns are abnormal and quick, then there is a great chance of having greater risk. If you are waiting very cool, patiently and for a long time and consistently you are watching, you are staying invested in the investment, naturally your risk is much more safe. So that means your risk is much more less. So the speculator invests the money for a short time, tries to get quick and abnormal returns, and is also ready to take the abnormal or greater risk. Whereas an investor stays in the investment for a long period, tries to get some good and consistent returns, and risk also is not ready to take very great risk. So this is the basic difference between the speculator and investor. And this is what I told movement also. He will put the money speculator puts the money very quickly and moves out very quickly. So this is it is there, whereas the investor sticks there for some time. Yeah. The nature of investment decisions. What is the nature of investment decision? Risk gets when you put your investment into the when you put your savings into the investment, the risk gets manifested when you buy them, when you buy financial assets. Because what will happen is, if you are purchasing gold or even land and property or some physical assets like that, your risk is usually it is very less, in the sense, okay, there may be variations in the gold prices or in the real estate prices, but when you are putting the money in your financial assets, the fluctuations and risk is more, because the financial markets move very quickly, and you cannot predict them very easily also. So the risk gets manifested when we purchase financial assets. So the whole purpose of this course is to minimize this risk and to get a better returns with a sound and informed techniques, maybe with the information available from the various sources and markets. So we are saying, what is risk and risk and risk? What is this risk? Risk is the probability that the actual return on investment will be different from its expected return. So that means tomorrow you are investing some money, say 1,000 rupees you are investing, and you are hoping to get 1,100 rupees after a year, for example. And if your return in the future, that is after 1 year, is not going to be 1,100, so that means your future expected return is slightly unsafe. That means you have expected for 1,100 rupees. Maybe if you get say 1,050 rupees, so that is a difference. There is a difference of your expected return and the actual return. So the portion of that there is an element. That means you are expecting 1,100 rupees, but you have got only 1,050 rupees. So that 50 rupees you call it as risk. So the possibility or probability of getting difference, there is a variance between your actual return and the expected return. So that is called the risk. So if you want less risk, then you have to choose your options like that. Otherwise, what will happen is there is a possibility of losing your whole investment. So government securities are that way comparatively. Suppose RBI bonds or even treasury bills. These are some of the safe securities. When you are putting money into it, that means your investment is safe. Debentures, they are of a very good company. Suppose Tisco, Telco or Reliance, if you are investing in their debentures, the risk is also almost nil, because they are reputed companies with good returns. So it is normally expected that they won't default on the payment of the debenture interest and all that. So that way it is also by and large risk-free in a sense. When you are investing in equities, the element of risk is very high, because equities, you just see it on the screen. I think we are running out of time. I will also try to finish it very quickly. This is the return axis. This is the risk axis. This particular point is government securities, where your return is less, but there is no risk. This point. When you come to the corporate deposits, there is slight risk, and also slight return is more than the government securities. When you come to equity shares, it is further high. The return is further high. Similarly, the risk also is slightly more than your corporate deposits. Coming to the next part is warrants and options. This is a slightly further risky investment. So naturally you try to get a better investment, a better return. And further is the futures. They are more risky, and there is a possibility of also getting more risks, more return. Yeah, from this graph, what we understood is the different type of financial securities offer different risk and return combinations. So you have to choose your particular whatever option, whatever level of risk you are ready to take, and whatever level of return you are going to get. These two things you have to decide for yourself. Then only you can go ahead and proceed further. Similarly, we have seen again in the graph, this risk and return, they are moving together, because see, when the risk is going up, your return also is going up. Suppose equity shares, compare your government securities with equity shares, there is this particular portion is the movement in the risk. So your risk has gone from here to this place. Similarly, your return has gone from here to this place, something like this. So they are going together. They are not different. They move in the same direction. When your risk is more, then you have more return also. Investors are, it is the responsibility and of the investor to select an optimal mix of investments so that investment mix should match with the risk and return expectations of the individual investor or even the corporate investor. So the level of risk is ready to take and the level of return is ready to get. These two should be matching, and according as per that expectation, the investor should get a balance of investment mix. Suppose if you want to invest 25% of your money in a very secured kind of investment, another say 50% in say corporate deposits, because it is slightly higher risk, and maybe after that you may invest another 25% in the equity shares. So you have a mix of different combinations of investments which have different rates of risk and different rates and different returns and different levels of risk. So it depends whether you want to invest 25% in the government securities or you want to put the whole of your 100% in the equity shares. It is the investor's own judgment. So with his own judgment he will select the investment mix. The proportions in the investment mix can change. Suppose today you may have a particular type of situation. Today you have some needs and you want more secure income. So you might be investing in a more secure things. Maybe after a few years you may be more financially sound, and you may be able to spare about 2-3 lakhs of rupees, and okay, even if I lose these 2-3 lakhs, I don't mind. If that is the situation, then you may like to put the whole 2-3 lakhs of rupees into the share market or equity shares and try to get a good return. Alternatively, a person who is going to retire in the future, near future, may like to have more stable and steady investments. So today he may be, since he is in the government service or in employment, he may be able to take slightly more risk, and maybe after retirement he is not able to take risk. So today he may have a combination of investment mix, but for the post-retirement period, he may have a different investment mix. Maybe there in that particular portfolio or in that investment mix, there may be more proportion of investments which will give you regular monthly incomes, so that his monthly needs are met. So the investment mix is always dependent upon one's own risk and return requirements, and they can be changed from the situation to situation. I think, Kamal, at this point of time we can break, and
if you have any questions to ask, you are most welcome to ask. You can dial on our toll-free number. In this particular session, we have talked about the risk and the risk return profile of investors, how the risk return profile changes with the time, and how the risk return profile can be managed with the different type of securities. In our next session, we would be talking in much more detail about the risks. What are the various factors which are affecting the risk of a particular instrument, that we are going to talk. Next session would be from 3:30.